Financial bubbles captivate our imagination and promise wealth, drawing in investors with the allure of quick profits and seemingly endless growth. But they carry a dark side, often hidden beneath the surface of exuberance. These episodes of speculative excess often end in devastating crashes, leaving financial ruin in their wake. Understanding financial bubbles is essential to learn from history's mistakes and to avoid repeating them. Throughout history, certain events repeat themselves, and financial bubbles are one such event, recurring with alarming regularity. They demonstrate the dangers of irrational exuberance, where emotions override rational decision-making, and highlight the fragility of financial systems, which can crumble under the weight of speculative frenzy. From the Dutch tulip mania, one of the earliest recorded bubbles, to the recent cryptocurrency crash, bubbles have left their mark. They have toppled empires, reshaped economies, and altered the course of history. By studying these episodes, we gain valuable insights into human behavior and market dynamics. We can identify the warning signs of a bubble, such as rapid price increases and speculative trading. We can understand the factors that contribute to their formation and collapse, including market psychology and economic conditions. And we can be better prepared for the next inevitable episode of financial euphoria and despair, arming ourselves with knowledge and caution. Financial bubbles continue to influence our world today, reminding us of the delicate balance between risk and reward in the financial markets. Financial bubbles follow a predictable pattern, often described as a bubble cycle. The cycle begins with a compelling narrative about a revolutionary technology or booming industry. This narrative captures investors' imagination, fueling initial demand. As prices rise, a feedback loop emerges, drawing in more investors. Easy credit conditions add fuel to the fire. However, bubbles are inherently unsustainable. Early investors cash out, triggering a cascade of selling and a rapid collapse. Understanding this cycle is crucial for identifying and mitigating the risks associated with financial bubbles. Tulip mania in the 1630s Netherlands was a period of extreme economic speculation. It is often cited as the first recorded financial bubble in history, setting a precedent for future economic crises. Tulips, newly introduced to Europe, became a coveted status symbol among the wealthy and influential. Their vibrant colors and exotic origins captivated the Dutch elite, who saw them as a sign of prestige and wealth. As demand soared, prices rose dramatically, leading to a speculative frenzy that gripped the nation. People from all walks of life, from merchants to farmers, began investing in tulip bulbs, hoping to make a fortune. At the peak of this mania, a single tulip bulb could fetch a price equivalent to a luxurious Amsterdam canal house, an astonishing sum. However, the bubble eventually burst, and prices plummeted, leaving countless investors financially ruined and in despair. The Dutch economy suffered a severe blow, with many people losing their life savings and livelihoods. Tulip mania serves as a powerful reminder that financial bubbles can arise in any market where speculation and herd behavior take hold, often with devastating consequences. The 18th century witnessed two major financial bubbles, the Mississippi bubble in France and the South Sea bubble in Britain. In France, the Mississippi bubble centered around the Mississippi Company, promising immense wealth from the New World. In Britain, the South Sea Company experienced a similar surge in stock price, driven by rumors of vast gold and silver deposits. Both bubbles were fueled by speculation, easy credit, and government involvement. The promised riches failed to materialize, and both bubbles burst spectacularly. Share prices plummeted, wiping out fortunes and throwing the French and British economies into turmoil. These bubbles serve as stark reminders of the dangers of unfettered speculation and the importance of sound business fundamentals. The 1840s witnessed Britain gripped by railway mania, a period of intense speculation in railway companies. The success of early railway lines sparked a wave of investment. New companies were formed, promising to connect every corner of the country. The public eagerly bought shares in these ventures. Parliament granted numerous railway charters, often with little oversight. This led to a proliferation of speculative ventures with unrealistic plans. Share prices soared, driven by a frenzy of buying. However, many proposed railway lines proved financially unviable. As reality set in, the bubble burst, bankrupting numerous railway companies. Railway mania serves as a reminder that even transformative technologies are not immune to speculative excesses. The Roaring Twenties, a decade of economic prosperity in the U.S., culminated in the Great Depression. The 1920s witnessed a booming stock market, fueled by technological innovation and easy credit. However, stock prices rose at an unsustainable pace driven by speculation. On October 24, 1929, known as Black Thursday, the bubble burst. The stock market crash triggered a chain reaction, leading to the Great Depression. Banks failed, businesses collapsed, and unemployment soared. The Great Depression highlighted the need for greater regulation and oversight of financial markets. Japan's economic miracle came to a halt in the early 1990s with the burst of its asset price bubble. During the 1980s, Japan experienced a surge in asset prices, particularly in real estate and stocks. Fueled by easy credit and speculative fervor, prices soared to dizzying heights. When the bubble burst, the consequences were severe. Stock and real estate prices plummeted, and the economy entered a prolonged period of stagnation. Japan's experience serves as a cautionary tale about the dangers of asset price bubbles and the challenges of managing their aftermath. The Asian financial crisis of 1997 highlighted the interconnectedness of global financial markets. The crisis began in Thailand, where a speculative attack on the Thai baht led to a sharp depreciation. This triggered similar currency crises in Indonesia, South Korea, and other countries. The crisis exposed underlying weaknesses in the affected economies, including weak financial regulation and excessive borrowing. The IMF stepped in with rescue packages, but the crisis had a devastating impact on the region. The Asian financial crisis serves as a reminder of the speed at which financial contagion can spread in a globalized world. The dot-com bubble of the late 1990s showcased the allure of new technologies and the perils of unbridled speculation. Driven by the rise of the internet, investors poured money into internet companies, often with little regard for traditional valuation metrics. Companies with a .com suffix attracted enormous investments. IPOs of .com companies became highly anticipated events. However, many .com companies were not profitable and had no clear path to profitability. When the bubble burst, the .com crash wiped out trillions of dollars in market value. The episode serves as a cautionary tale about the dangers of hype and the importance of sound investment fundamentals. The global financial crisis of 2008, often referred to as the Great Recession, had its roots in the U.S. housing market. It was a period marked by widespread financial turmoil and economic instability. Loose lending standards and complex financial products created a perfect storm. Banks and financial institutions were eager to lend, often without proper checks and balances. Subprime mortgages, offered to borrowers with poor credit history, became increasingly common. These high-risk loans were a ticking time bomb. These mortgages were bundled together and sold to investors as mortgage-backed securities. The complexity of these financial products masked their true risk. When housing prices peaked and began to decline in 2006, the system began to unravel. Homeowners found themselves with properties worth less than their mortgages. Defaults on subprime mortgages soared, leading to losses for investors. Foreclosures became a common sight across the country. Banks faced massive losses and liquidity crises. The financial sector was on the brink of collapse. Credit markets froze, and the global economy plunged into recession. Businesses struggled to secure financing, leading to widespread economic hardship. The global financial crisis highlighted the interconnectedness of financial markets and the dangers of excessive leverage. The ripple effects were felt worldwide. It led to calls for greater financial regulation and increased transparency. Policymakers and regulators sought to prevent such a crisis from happening again. The cryptocurrency bubble, which peaked in late 2021, demonstrated that the allure of speculative assets persists. Driven by technological hype and the promise of decentralized finance, cryptocurrencies experienced a meteoric rise and a subsequent crash. Bitcoin, the first cryptocurrency, emerged as a decentralized alternative to traditional currencies. The cryptocurrency market became a breeding ground for speculation and hype. When the bubble burst, the consequences were swift and severe. Bitcoin and other cryptocurrencies plummeted in value. The cryptocurrency bubble serves as a reminder that new technologies do not change the fundamental principles of finance. Financial bubbles from tulip mania to the cryptocurrency crash have left an indelible mark on history. These episodes highlight the enduring power of human psychology and the dangers of unfettered markets. Speculation often drives asset prices far beyond their intrinsic value. Leverage can magnify both profits and losses, contributing to the boom and bust cycle. Easy credit conditions can fuel speculative excesses. Understanding these recurring themes is essential for navigating financial markets. By studying the past, we can hope to navigate future financial turbulence with greater wisdom and resilience.
So hit that subscribe button, ring the bell for notifications, and let's turn the page on a new adventure together. Get ready to experience books like never before, only on VBook 360. Like, comment, and share to support the channel and keep the video magic alive. Thank you for stopping by. And remember, every video has a story, and every story deserves to be shared. See you in the next video.